Hello, I'm Boatman, Paterson, Executive Director of the California Housing Finance Agency. In addition to helping people become homeowners and providing financing for affordable housing projects, our agency administers Keep Your Home California, the state's federally funded Hardest Hit Fund program, which helps people avoid foreclosure and remain in their homes. California received $2.3 billion in funding from the U.S. Treasury to help low and moderate income homeowners at risk of foreclosure due to the financial hardship. Since the program was launched, Keep Your Home California has provided $1.6 billion in funding to 70,000 households, helping stabilize families and communities across the state. While it is easy for us to count the number of families that we have been able to save with these dollars, we knew the benefit of doing so was having a much broader positive impact on the communities where those families lived. In order to help us better understand those benefits, we chose the University of South Carolina's Darla School of Business, which had analyzed similar programs in other states, to conduct an analysis of the Keep Your Home California programs. I have the pleasure of being joined by the report's author, Dr. Joseph C. Van Nessen from the University of South Carolina's Darla School of Business, who is here to discuss the report's findings. Dr. Van Nessen specializes in regional economics, economic forecasting, and housing economics. He has conducted a variety of economic impact analysis, feasibility studies, and independent market research projects. Welcome, Dr. Van Nessen.
Thank you, Tia. It's great to be with you.
Thank you for joining me. Dr. Van Nessen, I'd like to start with talking a little more about these economic impact analysis work, and in particular, have you explain what you did when you looked at the Keep Your Home California program?
Sure. Well, the Keep Your Home California program has 5 specific program initiatives. And so what we did was to look at how the $1.2 billion was invested in California between 2010 and 2015, which was the period that we examined. And we wanted to see how those dollars flowed through California's economy and were able to preserve economic activity. We looked at that in terms of preservation of GDP, overall economic activity. We looked at it in terms of the number of jobs that were preserved, the labor income associated with those jobs, as well as the tax revenue that was preserved for the state of California as a whole. In addition to that, we also looked at it at a regional level. So not only the state, but we also looked at it at the county level. We looked at it across most of the major cities in California, as well as all of the congressional districts, both at a U.S. and a state level. And then finally, we looked at it from a specific program perspective, because each program initiative is going to have a slightly different impact. And to give a specific example of that, if in the case of a program where consumer spending was preserved for a homeowner who received some form of assistance from one of the program initiatives, then those were dollars that they were able to continue to spend in the local economy on a variety of goods and services that everybody spends, that you and I spend our incomes on. So whether it's food, whether it's healthcare, whether it's retail, all of these industries. And so the program initiatives not only help the housing markets in California, but also rippled through to other industries as well, and helps the economy as a whole. It's not just limited to housing by any means.
I see one area, housing, can have an economic impacts and several other factors. That's what you were just talking about. What were the results that you found looking at the Keep Your Home California data?
So the big number that we talk about, the total economic impact in terms of the value preserved, was about $2.5 billion. So in other words, the 1.2 that flowed into California generated a total economic impact in terms of the dollars preserved of $2.5 billion. That corresponds to about 8,100 jobs preserved, about $441 million worth of labor income, and about $81 million worth of tax revenue for the state of California as a whole. And to really follow up on that and to encapsulate those results and to summarize it nicely, one way to do that is to look at what we call the economic multiplier effect, which we estimated to be about 2.0, meaning that for every $100 invested in the state of California through the Keep Your Home California programs, a total of $200 worth of economic activity was preserved. That's a state average, and it will vary from region to region, depending on the nature of the local economy. So a more urbanized area where there's more industry activity typically will see a higher multiplier effect than a more rural area. So for example, Los Angeles has a multiplier of around 2.3 as opposed to San Diego, which is around 1.9. But those are that's a way we can summarize the overall estimates regardless of which region we're looking at.
That is very interesting. As someone who has worked in affordable housing for most of my adult life, I've always thought that housing and affordable housing and the preservation of certain programs may have this multiplier effect. In particular, I'd like this ripple effect and how this may have impacted our local communities. You said that varied throughout the regions. How do these results compare to some of the other studies that you have done, and are these results in line with what you would expect from a government program?
Well, let me answer the second question first, because when we look at different government programs, because they are highly unique and they're all very different, they have specific goals and they are typically applied in helping different industries. So it's difficult to make a comparison for all government programs across the board. So it's hard to make an apples to apples comparison there. But if we focus just on the housing market and on construction, I would say that Keep Your Home California is right in line with other government programs similar to it in terms of housing programs, and certainly right in line with the multiplier effects that we see in construction and in housing more generally. So I think overall, Keep Your Home California fits right in line with the housing industry overall, but comparing it across government programs, that's just a little difficult to do because they're so different.
Understood, understood. So getting back to the results themselves, can you explain how providing funding for foreclosure prevention assistance saved jobs, tax revenue, and otherwise impacted sectors where a direct connection is not obvious?
Sure. Well, with the foreclosure prevention, we're primarily talking about preserved property values and the associated tax revenues that go along with that. So when a house goes into foreclosure, as you know, we typically see a reduction in the property value associated with that particular home. But in addition to that, we also see a reduction in the surrounding properties, and we quantified that as well. So there you can definitely see an impact in terms of the changes in the property tax revenue. When we're talking about preserving jobs and incomes, however, that's more tied to the preservation of consumer spending on the part of the homeowner. So for example, if a homeowner is in a financial hardship, but they're about to come out of that financial hardship sometime in the near future, if they have the ability to take that new earned income and preserve their amount of spending in the local economy, rather than having to divert that funding towards reinstating their mortgage, then those are dollars that continue to boost the local economy, again, across a variety of sectors. And so workers in those sectors, in those industries, see their jobs and incomes preserved. And so that's how we get to those numbers.
So I think it's an important distinction to make here. You're not saying that Keep Your Home California created any particular jobs or created any particular economic activity, but that the Keep Your Home California dollars, the assistance that was provided, helped the continued or the presence of that economic activity in that local community. Now, as you know, Keep Your Home California program was made up of 5 different programs. We had a program that if someone had fallen behind in their mortgage, it helped to catch them up in their mortgage. We had a program that if someone became unemployed, it helped provide assistance so that they can continue to make their mortgage payments. So when we look at these different programs, we know that the investments that are the dollars are being spent in different ways. Can you give us an example or two of how these different programs may have a different impact?
Sure. Well, there are 2 major types of impacts that we looked at. One is the preservation of consumer spending, and the other is the preservation of property values through the direct avoidance of foreclosures. So 2 programs that would tend to manifest themselves through those different impacts we can go through. Number 1 is if we look at the mortgage reinstatement program. So in that case, you typically have homeowners who are often severely delinquent on their mortgages already, and who would probably, without assistance from the program, go into foreclosure before they were able to resolve their financial hardship. Not in every case, but in most cases. And so there we typically see the majority of the impact arising from foreclosure prevention, and the preservation of those property values is the majority of the impact. In contrast to that, if we look at the unemployment program, which is more geared towards preventing a homeowner from having to reinstate a mortgage down the road, in that case, it's more likely that if they were to come out of that financial hardship again in the future, that would be before they would be in a position where the house would be going into foreclosure. And so in that case, that new earned income would then be diverted towards reinstating their mortgage rather than being preserved in the economy. And so you would typically see more jobs and income preserved as a result of the unemployment program and more property values preserved as a result of the mortgage reinstatement program.
This leads me to my next question, which is about the assumptions of the model used in your analysis. How did you derive the assumptions upon which your model is based?
Well, the major assumptions that we had to make came into play when we were looking at the impacts of property values, or the impacts that came from the foreclosures and that manifested themselves through changes in property values. And so the way to look at that is to examine other work that has been done. There have been numerous empirical studies that have looked at this impact of foreclosures on property values. I mean, that's been done across the country. And so what we looked at specifically was data from the California Association of Realtors, which has documented the impact that a foreclosure has on that property value. And in addition to that, when we look at the adjacent properties within a certain distance, how does a foreclosure affect the surrounding property values? We took some conservative estimates from existing work that's been done in different markets in California. And just to put a specific number on it as an example, what we find is that homes within about a tenth of a mile, located within about a tenth of a mile of a foreclosure, tends to see a reduction in property value by between half of a percent up to about 3%. And so in the case of California, our assumption was that it was on the more conservative side, about 0.6%. Okay. Again, making conservative and realistic estimates about what these ramifications will be.
So by taking this very conservative approach, we know that this is at least what the impact is. It could be more. Well, I'm actually very glad that you took the more conservative approach. Make sure that what we're saying or claiming that we're doing, that is more accurate. If I were from a region, however, that had a lower economic impact than the average of the 2.0 multiplier, does that mean that the program was less effective in those regions?
No. The short answer to that question is no. It certainly doesn't have an effect on the individual homeowner. So the program is just as effective regardless of where you live in California. The reason for the different effects, the different multiplier effects, is largely due to basically the structural nature of the economy and the different local regions. So a more urban area, more well-developed area, tends to just have more resources for homeowners. So if you are spending, pick a number, $100, $1,000 in the local economy, if any homeowner is, they're going to be able to access more of the organizations that they need to, whether we're talking about food or healthcare or any other industry locally. And so those dollars are going to ripple through that local region. So San Francisco as an example. Whereas if they're in a very rural area or rural county, then they're probably going to have to purchase more of their goods from outside of that region. So more dollars are going to be lost or leaked, as we say. So it's more a function of the region, not so much the effectiveness of the program.
So along that same note, if I were to look at the data again in the future, could the economic multiplier improve, or would only the economic impact increase with additional assistance but the multiplier remain the same?
Well, it's certainly the case that if the assistance was increased, that's going to increase the total economic impact. But your point about does the multiplier effect change, the answer is yes. It changes very slowly over time, but it's a function of the economy. So when the economy is doing better, when the housing market is doing better, you will see the multiplier effect tick up over time, and in contrast, when the economy is not doing as well, you'll see the multiplier go down as well. So typically there aren't significant changes over short periods of time, but yes, it does change as we move forward depending on economic conditions.
Well, things seem to be improving in our state. Unemployment is down, foreclosures are down. We do know that a lot of people who did become reemployed are making less money, so a lot more of their income is going towards their mortgage. And so when the report was released, you had a great comment which I think is really important for people to hear. You said a strong and vibrant housing market is a critical component of a healthy economy. Housing is not only one of the largest sectors of the economy, but individuals who live in stable housing environments also experience many economic and social benefits. I could not agree more. Fortunately, in my position, I get to hear from people directly and just see how housing can impact them tremendously. I don't think I can emphasize that enough. Can you elaborate on those comments?
Sure, sure. Well, the benefits of housing, as you alluded to, come in two forms, primarily economic and social. When we talk about the economic benefits of housing, really from a broader scale, more aggregate level, we look at its contribution to overall economic activity, which has historically been between 15 and 18%, which is huge. I mean, that's a major component of the economy, whether we're looking at the state of California or whether we're looking at the U.S. As a whole. So critically important there. And as we're looking to ways to grow the economy in the long run going forward, of course, having more people work in the economy and increasing the population is part of that. We're going to see increases in the population as we see the labor force rise, and those are all necessary components of long-run growth. And of course, everybody has to have a place to live, right? So you can't have a thriving economy without a thriving housing market as well. So that's critically important. The second aspect to that is the social component. And it's been well documented that there are many social benefits to stable housing communities, and they range from everything from lower crime to better educational outcome for children raised in stable housing environments, to more civic participation. People in stable housing communities are healthier as well. Now, we didn't look at any of those in this particular report. We just looked at the economic impact there, so I can't comment on specifics from the social perspective, but I will say that those findings are very widespread and well known, and they apply across the board regardless of which community you're looking at across the country.
I have one final question for you. Now that we have this report, where do we go from here in your mind? For example, how should we utilize this information to shape policy? Now, I'm not asking you to come up with any policies or anything like that, but I think this report is a terrific tool for us to utilize going forward. And I certainly have some ideas on how we could use the information, but I'm interested in hearing your thoughts and on the implications of the report.
Well, I think it's important to look at Keep Your Home California and the impacts it has on the economy, and to look at that in context with the housing market more generally, and look at what's happening in California as a whole and even U.S. markets in general, and what the role of Keep Your Home California should be going forward. So for example, if we look at most housing market trends since 2011, the housing market's doing pretty well in California, recovering very nicely. We're seeing house prices appreciate really at much higher rates than the national average. But if we look back to 2006, just before the Great Recession began, and do some comparisons, what we find is that the average house that was purchased in 2006 would still be underwater today. And so if you just look at the data over the last 5 or 6 years in terms of what's happening right now in terms of market trends, then you may get an impression that, well, does Keep Your Home California still have a role to play? Maybe not so much. So I think it's important to keep that in context and look back and say, no, California fell a long way during the Great Recession, far more than most states. And so as we look ahead, even though we're in a more prosperous economy now, looking ahead, we still have to keep in mind that California is still recovering from that fallout during the Great Recession. And so Keep Your Home California still has a very important role to play as we move forward.
Well, luckily we still have another 3 years of that program because it doesn't expire until December of 2020. So I want to thank you again for joining me here today. Thank you for taking on this task of completing this economic impact analysis for the Keep Your Home California program. And I think this report is great. And I am eager to continue working with you and continue to working to keep more Californians have a place to call home.
Thank you, T. It's been great to be with you today.
Thank you.